What's going on, guys? Welcome back to another video. Thanks for tuning into Stock Essentials. My name is Alex and we're going to be going over some really interesting data, and normally we don't talk about tech stocks, but this one is not really moving that much in the market right now. Sure, it's up 8%, but biotech stocks are pretty volatile usually, and this one is kind of up and down. It's not really moving too much, but I noticed something. I was checking out barchart.com, the highest implied volatility options, and I noticed that the implied volatility for this stock, FBRX, Forte Biosciences, is through the roof. As you can see here, over 500% implied volatility, but the stock isn't really moving that much. So it means a lot of people are anticipating a really big move. They don't know whether it's going to be to the upside or to the downside. As you can see here, average volume is not that high, as we can see, 370K. But there was it was almost doubled increase of volume. So people are anticipating a really big move on the stock. And overall, it hasn't really been moving much. So implied volatility is through the roof. So if you want to get into this stock, you gotta be very careful. It's going to be very, very volatile, and mainly because this company is going to announce top-line data from its phase 2 clinical trial of FB401 for the treatment of atopic dermatitis on September 7th, 2021. In September 2021, that is next week, Tuesday. So we gotta be pretty careful about this, but it's a really good opportunity to play options. And I'm not talking about buying calls and puts. As we can see, implied volatility is absolutely through the roof. If you're buying options, you're most likely going to lose money. So the safest way to play this is to sell options, whether it be call credit spreads, put credit spreads, cash secured puts, or if you're holding over 100 shares, sell some covered calls. Premiums are very, very high, and the best strategy when implied volatility is high is to sell options and receive the credit, because these premiums are very inflated. As we can see, it's going to cost you over $1,000 for a put option that expires in 2 weeks. So very, very expensive options right here. And what I am personally looking at doing is taking advantage of the high implied volatility on these option contracts and selling a $15 cash secured put. And look how much premium we're going to receive: $405 of premium. Very, very high premium. That's because implied volatility is very, very high. So this is what I'm normally looking when I want to sell cash secured puts. It's these stocks that have high implied volatility, and then we go far, far out of the money in selling some really cheap put options that are most likely going to give us a really good chance of profit. So even though it's a $15 strike, which is 50% from the current stock price, it's still going to be pretty risky, because September 7th, next week, is going to be a binary event, and it's either going to make or break the stock. But overall, I do think that a $15 strike is the safest strike you can get, safest way to play this stock. If you want to capitalize on the higher than normal implied volatility and higher than normal option premiums. So we're going to be collecting $405 of credit here against our collateral of $1,500. So really, really high return on our capital here. And if we take a look at our ROI, it is going to be our premium minus our collateral. So our premium is going to be $405 that we're collecting, divided by our collateral, which is going to be our collateral of $1,500 minus our credit of $405, which is going to be $1,095 of collateral. So this only costs you $1,100 collateral. Pretty good for small accounts to sell a cash secured put, but of course keep in mind it is going to be risky. So I'm not really recommending you to do anything. This is what I'm personally looking forward to myself. A 37% return in just 2 weeks. So really high return, but you have to keep in mind this is also going to be a pretty risky play. It's probably the safest play you can make, but the stock is going to be very risky. Implied volatility is through the roof. People are anticipating a really big move, and so far the stock hasn't really been moving much. People don't know whether it's going to go up or down, but if we take a look at the 1 year, it's been pretty flat around the $40 mark. So we're really looking forward to selling this cash secured put right here. Lots of premium to collect and really good return on your capital. If we take a look at all-time lows, it's at $23.61. So we're basically going to be owning 100 shares of this stock if it drops below $15 at expiration September 17th. So really high chance of profit in my opinion. Delta is really low, data is really high. This is all very good when you're an options seller. And of course, if we end up getting assigned, our break-even point is going to be $10.95. If we end up getting assigned 100 shares, that's going to be our new cost basis because we have to buy 100 shares of the stock at $15 each, but we're receiving $405 of premium, which is going to effectively lower our cost basis. So basically the stock needs to drop by around 66%, 2/3 from where it currently is, in order for us to lose money. So I do think this is a really nice options trade, and it definitely is under the radar, and it's something that you should consider if you want to make some really nice return in just 2 weeks. So that's about it for this video. If it helped you in any way, please leave a like, comment down below if you want to see more option strategies just like this, and of course subscribe if you're new to the channel. It helps out a lot. Thanks for watching.